Everyone. Hopefully, you're having a good day. My name's Andy. My channel is Finding Value. Today, we're going to look at the property cycle and look at ratios, how to basically invest based off of the real estate cycle. It is part of the thesis. Someone was talking about maybe I should go over um, kind of the investments and how we could pair this up through time. So we can look at certain types of investments based off of ratios, based off the real estate market, based off the inventory levels of the real estate market, et cetera, et cetera. I'm going to walk you through a full cycle together. And when we walk through this full cycle, I'm going to show you potential investments that you could have done in history that work very well during certain periods of time. So when I say that this general area is good for technology stocks. Well, what does that look like? What are the potential returns? If we were to shift from technology stocks to, say, something like uranium or an energy company, what does that look like? What are the potential returns there? I can go through that with you guys and show you just how ridiculous you can outperform the market using this strategy. I'm not here to try to sell you anything fake. It's going to take time. And I'm going to give you a realistic, I guess, outlook on potential returns. And I'm going to cherry pick some data here, guys. I mean, I'm going to cherry pick some data. It won't be maybe as big of returns, but I'm just telling you what is in cycle and what is possible. And then you're going to have to do your homework to figure out what companies are going to follow the cycle. So, one, what I want you to kind of walk away with is a cycle exists. How do you determine where we are at in the cycle? Where are we at with the current cycle that we're in today? What is going to outperform and when do they outperform? And what kind of investments work well under certain market conditions? So this is what I consider to be one of the three pillars. I'm going to use technical analysis to validate everything and show you guys what it looks like. I'm going to be using ratios, and the market conditions are determine where we should be invested during what time. And I'm going to show you how this all works using data so you guys can understand how to play these markets. Again, if you need any help with anything, check out finding-value.com. We do have a 50% discount. September is the coupon code for a 50% discount on the monthly membership for only the first month. All right, guys, let's dive in. Let's take a look and see what I've got today. So this is what you need to know inside and out. It's called the 18-year property cycle. There are four phases to this cycle. There is a recession that comes down here. There is a recovery phase. This recovery phase usually lasts 7 years. There's a mid-cycle slowdown in the middle of it. Then there's another from mid-cycle to end, about 7 years of an expansionary phase of real estate. At the end of this, we're going to build too many homes, which is called the hypersupply phase. So as we work our way through this, we go to the hypersupply phase. That's where you have a whole bunch of inventory. We have the least amount of inventory is where the mid-cycle wobble is. We call it the wobble. And then here is where we have a whole bunch of inventory, but we are declining in that inventory. Is called the recovery phase. It is important to understand this 18-year property cycle because this is what is causing the rotation of money in the system. Mid-cycle slowdown to the peak is a commodity boom era. The beginning in a recovery phase is technology stocks, low inflation, low interest rates. This is an increasing interest rate environment in mid-cycle wobble to the end of the expansionary phase. High rates are going to be paired with a high inventory levels of real estate. Then a crash occurs. Generally, there's higher foreclosures, for selling. There's a lot of stuff that happens at the hypersupply phase. And then we'll come back down, interest rates fall. The curve is inverted on the right-hand side here. The curve's inverted and the curve uninverts as we fall back down. That is the cycle. This cycle interacts with the population demographic. So the demographic is ultimately the driver of it all, and it's interacting with the real estate market. Every time we get these surges of population increases, these surges in population increase, that is what's causing the underbuilt scenario. So a larger demographic comes into home buying years, it soaks up all the inventory, it sucks it all out of the system, and then we have to build our way into or out of the deficit scenario. And eventually we'll build too many homes, go into a hypersupply phase, and then the cycle starts all over again. So the cycle is ultimately being driven by home buyers coming in. Now, if you look, the way that you read this is you see how we see the 30s here. So you have to add 20 to 30 years to this. It's more over here because people are buying homes later. People bought homes earlier back here. So it's when the demographic comes into home buying years. It's not when they were born. So if they're born in 1940, you add about 30 years, and now you're at 1970. If you go all the way to the end of 1950, you add 30 years, well, that's 1980. So from 1970 to 1980, we would say most likely we were going to come into a very big baby boomer, because these are the baby boomers, into home buying years, and that we should see an inflationary period in the 1970s driven by credit expansion into the system from the banking system. That credit is expanded through fractional reserve lending. That is the lending that we have from our banking system. That's how it's set up. So we have a big boom coming. We have to add about 35, 36 years for first-time home buyers. And that is where we come. So if we go 1990, which is about here, 1990 plus 36 years is 2026. If we take the peak over here, you're looking at 2028 maybe. It highly depends. It's not going to be perfect, but that's going to get you in that general ballpark. So it's somewhere middle to end of 2020s is where the demographic peaks. Remember, the demographics interacting with the real estate market. So the real estate market has to be in hypersupply at the same time that the demographic peaks over here. So it's the combination of those two things. That is what's driving this cycle. So now you know what the cycle looks like. You know the four phases. And now you know what is interacting with the cycle to cause this cycle to occur and repeat. One thing that we look for in an alignment that we hope is an alignment is we want the commodity to equity ratio to be cheap at the beginning of the demographic coming into home buying years. That is like the ideal movement. So the real estate market interacting with the demographic puts us into a commodity boom in this cycle here. That's where we want. We want to go into an expansionary phase of real estate. If we look, 1970 was cheap, 1999 was cheap, and early 2020s is very cheap for the commodities. It was expensive in middle of 1970s. It was expensive. 1990 was expensive, and 2008 was expensive for commodities. So cheap commodities, expensive commodities. Conversely, equities were expensive on the bottom here, and equities were cheap at the top. So you want to be going long in equities in potentially the mid 70s or the early 80s in 1990, and then after the 2008 crash. So generally you wait until it crashes back down some, and then it's like 09, 91, and you could potentially be in mid 70s or early 80s here. These are all cheap areas. This is the real estate cycle seen through the housing starts. That's incredibly important. So if we look at this and we look at how we're positioned, you'd want to be positioned in the early 1970s because this is going into an expansion phase. This is the average. The white line's the average, and we want to be in commodities when we go into expansionary phases. Another expansionary phase in 1998-99, another one here in 2020. So if you were to look, we were in expansion phase 1970, 1998, 99, and then to 2020-ish, 2020-ish, 1998, 99, and 1970s, early 1970s. Um, the ratios tell you where money has flown and where it is not. Money is in commodities here, or not in commodities, but in equities here. Every one of these things. So we want to be in the sector where it's down very cheap and where the money is not. And we want it to go into an expansionary phase where money starts to rotate differently into the system. That rotation of money that is different is going to prefer certain assets and move away from others. The money right now is all piled over into equities. That's why this ratio is so low. So the money's all over in equities, it's not in commodities. And we are entering an expansionary phase of real estate here, which we've entered in 2020. We've pulled on back from interest rates, but we're going to build those homes, in my opinion, because of the deficit we have, and I'll talk about that deficit next. So we're entering an expansionary phase. We are in this phase right in here. The reason I think we're in that phase, and I'll show you the data later, is because we have low inventory. When you have low inventory, that means that you're at the beginning of the expansionary phase. It means that you've drawn down your inventory to very low levels, and you have not built back that inventory. So that is where we're at in the cycle. Now, have we had the mid-cycle slowdown? That's confusing because generally when you have the mid-cycle slowdown, that is from an increase in interest rates due to the expansionary phase kicking on. And we get a wobble from the overall markets coughing or puking on itself from the increase of interest rates. I kind of think that we've already gone through it, and I'll show you data that may align with that. So there we are. There we are in the expansionary phase of real estate. This is the cycle. We come up into expansion. We go into a hypersupply phase. We go into a recession, and then we go into recovery phase, expansion phase, and then this thing just cycles back and forth. The recessions are all on the bottom here. The expansionary phase are all on the top above the average. We went into a very large, we'll call it recession, where we underbuilt a massive amount of homes. So if you go to and you did research, what you're going to find is it says the answer is to build more, a lot more homes. Looking at the number from American households, the number of vacant housing units, Freddie Mac, the government-sponsored purchaser of mortgage-backed securities, estimates a current supply shortage of 3.8 million units, driven by a 40-year collapse in the construction of homes smaller than 1,400 square feet. The 40-year collapse was this collapse here. This is the collapse of homes. It's the area under this curve over here. That is the collapse in home builds. You can see the areas under the curves are much smaller in previous cycles. We have a big problem in our housing market with an underbuilt deficit. The deficit is 3.8 million according to Freddie Mac. The Group Up for Growth also arrived at an estimate of 3.8 million using data on the total demand for housing and the overall supply of habitable available units. The National Association of Realtors compared the issuance of housing permits with the number of jobs created in 174 different metro areas. It found that only 38 metro regions are permitting enough new homes to keep up with the job growth. If you look at the bottom here, it says the NAR estimates an underbuilding gap of as many as 7 million units. So we have an underbuilt scenario somewhere between 3 and 7 million units, depending on what numbers you take. Another way that you can validate where we are in the cycle is based off of inventory. The reason I'm using this one is because it goes all the way back to 1964. Low inventory is anything below 6 months. 6 months is average. That's the green line, average. These are high cycles or high areas where the inventory is in a glut. We have too much inventory. Right now, we are where the green star is at. We are at a very low inventory across the nation. We can also conclude that the cycle is done when we enter these hypersupply phases. That's where the inventory is above 8 months to 10 months. These are all hypersupply phases in these blocks. If you were to look at these blocks, they perfectly coordinate with these bus cycles here, 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 and here. 72, 73, or this is 73 or 4. This is 1980. This is 1990. This is 2008. This is 73, 74. This is early 80s, 1990, and 2008. They all perfectly align. It shows us when the cycle is done is when the inventory is between 8 and 10 months. This is further data signaling where the inventory is. I didn't update this, but we're very close to this general vicinity. That's about 2 months of inventory, roughly speaking. So we're at about 2 months, slightly more than 2 months of inventory where the star's at. That's where we're currently at. Our inventory levels are lower than any time in history, going back to 1964. This is telling us that we've got this underbuilt scenario of 4 million to 7 million units, and we are at the lowest inventory of this time frame. It means there's a large deficit and that there's an imbalance in the system. This imbalance will solve itself through an expansionary phase of real estate, coming into an expansion phase, and that will be inflationary, which again rotates money into commodities because commodities outperform in this expansionary phase of real estate. It's all interconnected. And the demographic driving that is the millennials. Another thing that we can look at is we can look at foreclosure activity. And foreclosure activity in the first half of 2023 ticks upwards toward pre-pandemic levels, but we're at very low levels here for foreclosures. What that means is that we're not going to get forced selling in the housing market like we did in 08, 09, 2010, 2011. This was the recovery phase. We can see that we recovered. We've gone through that recovery phase. And right now we're at a very low level for foreclosures. And we do not have delinquencies. Here's our delinquency rate on all loans on all commercial banks at very low levels. The system is very strong at this moment. We are not coming into 06, 07, 08 where we're coming into a large delinquency rate or a high foreclosure rate. These were booming in 06, 07. They were coming way higher for foreclosures. So we don't have forced selling. I don't think we're anywhere near a hypersupply phase with the deficits that we've got in the housing market. We can compare that to how low our inventory levels are. That is also signaling that we are in the beginning phases of an expansionary phase of real estate, which means that we're at the beginning phase of a commodity bull market with ratios as low as they are at. And I'll show you the real-time ratios, guys. I'm just giving you the background history. And right now, we are still at very high levels of real estate commercial bank loans. They haven't come back. We're not in some movement lower, at least not yet, but we can watch that. So let's use that information that we've gathered here, and let's start to look at potential investment opportunities. So if we were to use that cycle, and we might go back and forth here real quick. So if we were to use this cycle, this is the commodity booms, and this is the S&P 500. What we're going to look at, and I'm only going to use more recent data because that's the data I went over and we have. So these commodity booms, we can see that the S&P 500 goes sideways during these commodity booms. And I am projecting that we're in a sideways movement for the S&P 500 as the commodity boom is going to take off right now. Why do I think we're in a commodity boom? Again, you go back to the real estate cycle. We're entering an expansionary phase of real estate. We've got a large deficit of homes in the market, and interest rates are going to go up. Inflation is going to go up because of the credit expansion of the real estate market and its inflationary impacts on the market with increasing interest rates. So if we were to look at all those things, we have all that. Now, how do you exactly play all this? What does the cycle look like? How do we go through it? Well, we're in an expansionary phase, and that's where I'm going to start. I think we're going to go sideways in the S&P 500. because we're in that expansionary phase, which means it's going to be inflationary, and it also means that interest rates are going to increase. I can back that data up by looking at the long-term trend line for the 10-year yield. The 10-year yield has broken its downtrend line, the blue line, and we're in a new shift to an increasing interest rate environment. So we want to be piled over in commodities. That means that when we look at the commodity to stock ratio, we should be breaking the downtrend line. Let me get off logarithmic here. So we're breaking this downtrend line. This is your peak, the top circle to the bottom circle. And then this is your bottom here. You want to be in commodities here, you want to be in commodities here, and you want to be in stocks here. Now, what is the potential returns for someone doing this play? How would I play it? Well, right now, I would be in commodities. We've got our first leg higher. This is our pullback, and now we're making our way again where commodities are going to outperform the S&P 500. This is wave 1, wave 2, and potentially wave 3 that we've just entered. So that's where we're at. We're at a very low level. Right now, our commodity to stock ratio is at a lower level than what it was in history before 1999. We're at a cheaper position for commodities to outperform equities today than in the beginning of the last commodity bull market. So there's more upside potential when the money does rotate, and it is rotating, into commodities. So in 1999, we'll do one full cycle here. That's one full cycle, and now, so we're going from bottom to bottom. So that's the cycle we're going to go to. Looking at history, the spots to be in 1999 were, I think, mainly energy. So if we were to look at a potential company here, we could look at SM Energy. And we can look at SM Energy and look at the potential outperformance that had during that time frame. So I've pulled up SM Energy. This is what it looks like, and we can kind of go back and forth based off of that ratio that we've got. So here's SM Energy. We saw the bottom in 1999. So 99 is where we should have been buying this natural gas and oil stock. It's a highly leveraged oil and natural gas stock. I bought it here at the bottom in 2020 using this same approach. And oil, natural gas, and uranium are some of the best investments because of the leverage they offer to the market. SM Energy is a highly leveraged natural gas company. They also sell oil. Our ratio and where we were entering in 1999 said that we should be buying oil and natural gas equities in 98 and 99. 98 and 99 would have been this section right down here. That is where it says we should be buying this particular stock. And yes, it bottomed earlier, but the signal based off of where we were at said that we should have been buying it in this region. We would have been buying it if we had cost averaged in this area at about $5. $5 is right here. That could have been a good average price, roughly speaking. If we had ridden, and if we have confidence in the process here, we load up at $5. It's a nice, easy number. And we would have ridden this all the way up during the expansionary phase of real estate. Our sell point would have been 2008. So we would have sold somewhere in this entire region here. It could have been $55. That would have been 11 times your money. 11 times your money, just to let you know, or we could call it 10 times if you get out at $50 on an average. So 10 times your money, you put in $100,000, you'd have $1 million from 1999 to 2008 in SM Energy. That is when we want to sell out because the expansionary phase of real estate went into a hypersupply phase, and we would have sold out here and then rebought back in other companies at the bottom here. SM Energy, since it's a good company and energy was still in a bull market, you could have bought back in maybe at $20, rode it back up to 80, but that wouldn't have been the play in my opinion. I would have gone somewhere else. The reason I would have gone into technology stocks in 2009 is because that's where the cycle was at. So we would have played the cycle from 99 to 2008 here in, say, a company similar to SM Energy. Then I would have gone and looked over at the overall stock market. In 2009, that is where uh, companies have really put in. Here's your Batman pattern, just to let you guys know. There's a Batman pattern. That's a topping pattern. We were going to go lower. We went lower based off the real estate cycle and the deleveraging of the real estate cycle. Since we were in a recovery phase, you want to buy these types of stocks in this general area down here. You would have gotten a year or two to purchase United Health Group or MasterCard or Visa or some of these big companies that do very well in a low inflationary, low interest rate environment. They also printed more money, and it did help us because that money went into financial assets. So you could have purchased this at about 25 bucks on average. That's 25 bucks right there, 2009. You load it into United Health Group. I am cherry picking the data. I did buy United Health Group. I'm using companies that I purchased at these times. Did I know this real estate cycle, the real estate cycle, as well as I did back then? I did not. I know it a much better today. So 25 bucks, we would have ridden it all the way through the recovery phase, and we would have ridden it to about where it is in 2020 is probably about where I would have chose. 2020, it was at $326. $326 from 25. That is way past a 10 bagger. What is that? That's 10. So it was 25, 250, and then another 100. So that's another four. That's 14 times your money, roughly speaking. 14 times your money is now $14 million. You made in 1999, you made a hundred. You turned 100 grand into a million. Now you turned a million into 14 million, and you would have hopefully moved back into the stock into stocks. So in 2020, we had that big blowout bottom crash. Remember that we were looking at our ratios. Our ratios are telling us that we should be swapping it in 2020 into other companies. So we would have missed out on this top here in United Health Group. We don't want to be in it. We want to go after what's a better opportunity. So we would have swapped it in here at about $300 or so and moved it over back to, so let's say, SM Energy. So in SM Energy at that time, oops, that's not SM Energy, that's something else. So here's SM Energy. We would have been looking, and we saw in the ratios that we should have been buying SM Energy here. We've got $14 million since 1999. 1999, that's when I graduated high school, if I could get that money. So we've got 14 million bucks. Now this is going to get interesting. I bought SM Energy at $1.50. 14 million divided by 1.5, you own 9.33 million shares. It's now at $42.28. So it's times 42.28. You'd have $394 million. You would have actually you'd have a big chunk of investments in SM Energy. You'd be like a majority owner almost. What is it? It's a 5 billion market cap. You'd have 400 million almost in this. So you'd have 400 million. So you essentially you could turn 100 grand into $400 million in one little over one cycle. A little over one cycle. So that's what I'm trying to tell you is that's the power that you could have. And I'm undercutting this, guys, because when we had this crash here, I wouldn't have gone directly into United Health Group. I would have went into bonds first. So let me recalculate that real quick on one cycle, just to get you guys one cycle's worth. So you made $1 million, roughly speaking, on this 10 bagger in SM Energy. You swap that over to TLT. TLT is when we would have purchased in at the peak of 2008. At the peak of 2008 would have been this section here. So 2008, you would have bought in at $90 a million shares. just or $1 million worth of shares. So 1 million divided by 90, you'd have that many shares in TLT bonds. You wrote it all the way down to '09, which is this roughly speaking in here, 118. So let's say we get to 110. All right, we sell out at 110 just to make it easy. So we've got now we sell out at 110. Now you're at 1.22 million. You then swap your stock over to United Health Group. So you divide it by 25 because that's what it is per share. Now you've got 48,888,000 shares. So you buy United Health Group, just as an example, guys. And United Health Group, you buy it at 25 and you buy it in this general region here. You sell it in 2020. That's where the sell point was at about $300. All right. So you sell it at 300. So you have that many shares times 300. Now you're at $14,666 million. That is what you've got in one cycle of moving it. You buy your SM Energy at $1.50 where I bought it. You've got 9.77 million shares, and SM Energy is trading, I think, at 42.28, and now you're at times 42.28. You've got $413 million. This is why Buffett can't invest in some of these smaller cap companies, because you just start making too much money. That is the cycle, guys. And right now, if you were to look at everything and you were to use the ratios and use the cycle, we would not be selling out of this. We would still be in it, and that's what your current net worth would be just using those two assets. Obviously, you can choose a bunch of different assets. You can, one of the ones that I would choose would be MasterCard in 2009. 2009, here's MasterCard, got to a very cheap level in '09 down here. Let's just call it 16 bucks. $16. MasterCard's now at 411. I wouldn't have traded out. I would have traded out earlier than that. I would have gone into 2020, probably at this section here. I would have sold at about $300. So 16 to $300, that would have been a better investment. It did 300 divided by 16 and 18x. So you would have made even more money going into MasterCard during that time frame. So let's say you started at about $1 million, you'd have 18.75 million using MasterCard for that one cycle since 1999. That's how you do it. Right now, the cycle, since we're at the expansionary phase of real estate, in my opinion, you'd want to be long commodities right now because of where the ratio is at, and that we're showing right here. We're at a very low ratio, and not only is it low, it's starting to break to the upside here and gain some momentum. In my opinion, energy is probably one of the best sectors. Why is that the case? Well, if you do like a uranium to stock here, let me scroll down to the uranium section here. And let me see if I can find it. So uranium is about to outperform basically everything. Uranium is about to outperform all these different assets. It is cheap and about to move up. So that's uranium versus silver, uranium versus the SPX just breaking out, uranium versus gold. It looks like it's ready to break out. Uranium versus crude oil, uranium versus copper is about to break out. Uranium versus nat gas, still at a very good level. Uranium breaking out against stocks, and then uranium versus palladium, which is also breaking out as well. So it's very cheap. And then you look at the equities. URNM versus US, or I'll do URA with more data. Uranium versus that, and we're at a very low level that it's just breaking out to the upside. So basically, this is one of the best opportunities in the market based off of all the tailwinds, based off of using the real estate cycle to our advantage, using ratios to tell us where the money is and isn't. It's not in uranium equities right now. Money's going to flow back into this. People are going to FOMO into it. The retail sector is going to catch wind to it. And this is one of the best opportunities. Another one that also does very well that's going to come into cycle here is the XAU to gold ratio. These are gold and silver mining companies. This is also at a historical cheap valuation. We can throw this downtrend line, and you can see that we haven't broken the downtrend line yet, but we're getting very close to a level where we could break it. So right now, if we were to look across all the markets and across all the tailwinds and market conditions, we can see that we're in an expansionary phase. Commodities are going to outperform equities, and that the cheapest potential investments in the market today is uranium and also gold and silver mining companies. If we look and we were to look at the technical analysis on, say, something like gold, and we were to look at the technical analysis there, we're sitting on top of the pattern here, guys. This thing is ready and primed to launch at any second. There's other things we can look at, like the TYX TNX ratio. That's also favorable for gold. So if I were to put gold up here, and I'll show you guys exactly what it looks like. When this ratio goes low to high, the gold also outperforms. High to low, gold goes sideways. Low to high, and gold is sitting on top of its pattern. So this thing is basically primed to work its way higher here at any second. It's just waiting for the right market conditions for this thing to rip to the upside and gold to rip to the upside. Silver is also prime in a squeezing pattern that we're in. We're squeezing up on the right hand side here. Let me go to the dailies here. We're squeezing up. We're probably going to come to this support zone here very soon. It's going to squeeze up, and if the right market conditions come, we're ready to go. So we're just waiting for that breakout for gold and silver mining companies, and the breakout for gold and silver, the metal company, the physical metals as well, to break out. So we've got very low ratios, very big runways ahead of us for some of these assets, and we're just waiting for this to all queue up, basically, and ready to rip. When it starts to rip, we'll invest in them. And that's where you're going to get your big returns. This is what's possible. And I didn't even use the best companies during that time frame. I just chose companies that I know that do well under certain conditions. United Health Group is a very large health insurance company. It's nothing special, so to speak. Another one, MasterCard. I have a MasterCard and I have a Visa card. I would put my money into those. Those are also both very large companies that have very big runways ahead of it. So I'm just using the cycle to my advantage. I back tested this. I looked at all the data. I came up with this, not just myself. I think it is out there to some extent. I don't think people have really dove into it as deep as I have. And at the website, the finding-value.com, that's what I'm using. That's what's driving all this. I'm using the technical analysis for an unbiased approach to see how this is all playing out against each other, how the herd is basically moving, and we're front running those money flows. I'm using the ratios to determine what's cheap, what's expensive, and I'm using the real estate cycle to determine the market conditions that these assets are going to rotate under. That's basically the full thesis. I've got a couple of other videos before describing some of this. What's possible? Hundreds of millions of dollars if you can get in early enough. If you can use this strategy early enough in your life. I can help mentor you. I can teach you this. I can show you the fractals, how I'm doing stuff in the charts to get the biggest returns. I can tell you how I'm basically breaking up my portfolio. I don't have exact quantities or percentages because those quantities and percentages change daily. They can change dramatically based off what I think looks good. And I tell you guys in these midweek updates, which I do on Wednesdays, and during the question and answer sessions, you're going to cover absolutely everything you need question-wise on where we are in the cycle, on updates, and all that stuff. If you're interested in joining, but that is what the potential is. That's the powerful nature. You can also do this using physical metals, reducing your risk. And I play both. I play both the high risk, high reward companies. I play kind of middle range, big cash flow companies. And then I also play just physical metals in the swapping ratio game. Right now, if we were to look, there are incredible setups in the physical metal space as well. So that's what I do. That's the whole deal there. That's what I figured out, and that's what I'm using to guide my strategy. Or that is my strategy. All right, guys, that's what I've got for today. Thumb up for the content, subscribe to the channel, subscribe to the website if you like. Again, we got the 50% discount September if you want to learn this. And what's the potential? Tens of millions, hundreds of millions of dollars, depending on where you start investing and how much risk you're willing to take. I will let you know what the riskier companies are. There are strategies where you don't have to go full risk. You can put a little bit in the high risk, a lot in the lower risk, and maybe even play the physical metal game, as we've got really good entry points in that game as well. And that game can also turn very little money into millions of dollars. But you have to buy when people are not looking. You have to buy when the things are down. And this is a way to objectively quantify where we're at in the cycle and what is cheap, where it's cheap, and what potentially could outperform based off those conditions and the money rotating differently in the financial markets. All right, guys, we'll catch you later. This is Finding Value.